Testing, 1, 2, 3. All right. Good morning. How are you guys this morning? We're ready to rock and roll. Made a little mistake in my setup this morning. I scheduled the class for 7:30 instead of 7:25. I generally like to schedule it for 7:25, but I tried to start at 7:25 anyway, so we'll get moving and rocking and rolling here. First thing we want to do is we want to talk about what's going on right here on the screen. Up on the upper left-hand corner is the S&P 500. Upper right-hand corner is the Dow. Bottom left-hand corner, we got the Russell. Bottom right-hand corner, we got the NASDAQ. We are looking at the futures market. We will be going over and looking at the stock market today. We are going to look at our options. I had a wonderful class last night. Sometimes it looked like the class at the university. I teach a night class at the university, and this is the lab for that night class. So everybody's welcome. You don't have to go to the night class to come to the lab. You can certainly come and join us here online. And that's one of the benefits, the great benefits of being on YouTube. We've tried to do these labs in other places. I used to try to do them at a friend's hangar at the airport. I used to try and do them at the library. I used to try and do them at another guy's house. We tried to do them a number of places, tried to do them at the university. And every time we kind of got into problems, got squelched one way or the other. So we decided, you know what, we're just going to do it online. And I could have done it privately, just in a private little session, but I thought it would be more fun to just do it out here in public. Do it online. Do it with the YouTuber live thing software. It's all designed for that purpose. Works really good for the most part. There's still some things that I wish I could do a little easier and a little better. But look at that Russell getting ready to drop out of the bottom, drop the bottom out of that thing before the market's even open. So we are in the futures market, and so the market is open in the futures market. The market trades 23 hours a day in the futures market. So a lot of people look at this and they'll say, well, this is the pre-market session, right, Lan? Well, kind of, because we are looking at the stock market. This is the pre-market session in the stock market, but it's not the pre-market session in the futures market. In the futures market, there is no such thing as a pre-market session because the market doesn't really close, and we don't change the rules. And that's really kind of the difference between the pre-market session in the futures market and the pre-market session in the stock market. We don't change the rules over here in the futures market. In the stock market, they got different rules for trading before 7:30 than they do trading after 7:30. 7:30 is their opening bell. That's when they open it up and they fill all the, the clearing firms come in and fill all the nighttime orders. They don't actually fill the orders during the pre-market session. In the stock market, they wait. They wait until the opening bell, and that's when they fill that's what the opening bell is. That's when they fill all the nighttime orders. So daddy comes home at night after work, buys a couple of shares of Microsoft, and they wait until 7:30 in the morning. That's 7:30 my time. I'm in Utah. I teach at Utah Tech University, so I'm in Utah. So 7:30 my time, 9:30 New York time. That's when they fill all the nighttime orders, all the ones that daddy and mommy came home from work and put into the order after work was over, after the market was closed. So they go, and that's when they fill those orders. And that's why the market runs like a bunch of ponies. That's why you kind of like the ponies coming out of the gate. Now, depending on whether all those mommies and daddies who came home from work and placed their orders in nighttime decided to buy because they felt one reason or another that they should buy the market, or whether they felt the reason they should sell the positions they had will determine, for the most part, how this market trends right out of the gate. All right, so we've got 6 seconds to go. 5, 4. Here goes the ponies. They're going to open the gate in 1 second. There they go. Boom, they open the gate. What are they going to do? Is it going to go wild and crazy and jump all over the place? Down goes the Russell. Look at it go. Everybody's selling out of their, looks like they're trying to sell out of their positions. Now it's going to fill some orders going long, fill some orders going short. Look at the Dow. It's just taken off. Everybody wanted to buy into the Dow, so the Dow's starting to rally. The S&P will oftentimes follow because, again, they're filling the orders of these different markets. Now, the S&P has 500 shares, right? There are 500 different stocks. So there's 500 stocks in the S&P 500. That's why the 500 number is there. You have the Dow. which is 30, the Dow 30. You've heard that number. Look now. So the Russell flushed down hard first, and now it's starting to climb really hard. So they ran a whole bunch of sell orders through first. That's what happened first. And now they're running a bunch of buy orders through. So and the NASDAQ is the 100 top of the NASDAQ. It's mostly high-tech firms like Microsoft, Apple, Netflix, Google. So they're dumping all those. They're like, let's sell out some of those. The Dow Industrials, though, those are being bought up right now. Let's buy a bunch of those. So the S&P, with this morning bell thing usually takes about 10, 15 minutes for them to clear out all those nighttime orders. They got to find buyers for the sellers. They got to find sellers for the buyers. So who's buying and selling all these nighttime orders? Well, it's guys who like to trade right out of the morning bell. They like to jump in and start buying and selling. Well, who are they buying and selling with? They're buying and selling with these big clearing firms that are clearing out these nighttime orders. So that's what's going on right now. And that's why I kind of, I set aside. You can do what you want. I'm not here to tell you what to do. I'm just telling you what I like to do. And I've been doing this for about 30 years. Of course, I haven't been day trading for 30 years because we haven't been able to day trade like this for 30 years. Back when I started trading, it was all paper charts and they'd come to you in the mail. And then how would we update our charts? We'd get the newspaper and we'd look in the newspaper and we'd see what corn was trading at and we'd update our chart, our paper chart. And every week we'd get a new set of paper charts and we'd have to start all over updating our charts one day at a time with the newspaper. And then the internet came along and we were able to start, getting some prices over the internet so we could get prices every day. And then I started printing charts off and I went through reams and reams of paper, and my wife would get so mad at me. Why are you printing so much paper? That's a waste of paper. You're cutting down trees. So we stopped doing that. Started trying to find software that would work for us. And that was a difficult thing back in those days. It was just trying to get a decent piece of software that we could use to trade on. And I finally got sick and tired of trying to find a piece of software that I liked. And I just hired some programmers and wrote my own. And that's where Track and Trade came about. We just got sick and tired of trying to find a piece of software that would trade the way we wanted to. We just wanted to trade. That's all we wanted to do. And everything was all about analyzing markets and doing all this crazy stuff and writing software, code and programs. We just wanted good software to trade with that was really efficient and designed to trade. So we just wrote our own. And that's what Track and Trade is. It's a software that I designed and wrote. And I started a software engineering firm. And lo and behold, little old Track and Trade that I wrote here won Stocks and Commodities Annual Reader's Choice Award 7 times. So that's pretty cool. All right. So 7 times this software's won Stocks and Commodities Annual Reader's Choice Award. And pretty proud of that, of course. And it's, because it's just designed to trade. That's what it's designed for. It's just designed for traders. And it's very efficient. It's very, very efficient at what it does. But it's not free. It's not something that you just go run down the old internet and download for free. There's actually a team of programmers that we got to put socks on their feet. And as I always say, I try to tell them they don't need socks for their kids. No socks for their kids. But they say, no, Lan, we got to have socks. So you got to pay. You got to pay for the software. How do you pay for the software? It's a one-time fee. You pay one time. That's all you have to do. Just a one-time purchase. It's a lifetime license to get this software. You buy a lifetime license, and then you have it forever. All you have to do is just buy the data from the exchange to feed it once you've got the software. And as long as you're feeding it data, it'll work. And the programmers will keep it updated for you, keep adding new features. All right, we're watching these ponies run. Here I am talking and talking and talking, not paying enough attention to place any orders. The Russell right out of the gate, Russell 2000, it's running sideways. It's not doing anything for us today. The Russell is usually the one that moves. It's the one that usually kind of trends for us. But the last few days, and I like the Dow. I've had really good luck trading the Dow. Dow's been a good market for me. But I want to show you something. See these white lines right in here? Guess when I put those on? I put those on yesterday. Those are yesterday's bracketed market from the high and low of the yesterday's trading market. That means that this market has not done anything, has not broke out of yesterday's channel all the way into today. That's pretty crazy. This right here, the S&P, that was yesterday's channel. I did not take those off the screen. That was yesterday's channel, the morning breakout channel right there. So this market's broke out of that yesterday channel and gone kind of crazy on us. Okay, it's moved quite significantly in the pre-market session. This is the down here. This is the yesterday's channel for the Russell. So it's dropped a little bit since yesterday's channel. So that's yesterday's channel. Where's the channel over here on the NASDAQ? It's way up there. So if that was yesterday's channel for the NASDAQ, we're down below the channel. Directly in the channel for the Dow, below the channel of the S&P, below the channel on the Russell, and way below yesterday's channel on the NASDAQ. But that's interesting for you because I want to point that out to you because we're talking about options. And we're getting into the options world, and we talked about options last night at the university, and we talked about selling options. Now, I've got some examples in here where we bought options, right? We went in, was it yesterday? I think we bought a bunch of options yesterday, and we bought a bunch of options on Monday. And so we're going to jump over to the stock market version because we put the options on in the stocks version of Track and Trade. And we're going to look at those options here in just a minute. I like to watch the ponies run here just out of the gate, see what's going on, see if there's not an opportunity for us to put a position on quick, take a quick scalp or try to get into a little trend. But I'm not seeing anything I love right here. The Dow is the one that's looking the most promising. Everything else is just kind of dead across the board. Lots of topping tails, lots of bottoming tails. We are looking at the Heikin-Ashi bars. These are Heikin-Ashi price bars. Heikin-Ashi bars have kind of a mathematical model built into the price bars themselves that kind of is a smoothing component. And so they are designed to help you trail your stops, really is what they're trying to do, and give you an indication of the overall market direction. So we are bouncing off the VWAP up there. That blue line is the VWAP. This is a continuation formation right here. We should be able to get into a long position on the Dow, and we should be able to take that red pullback. See how it has this is an ABC pattern. So this is what we're looking for. A, B, pulls back, and then we're looking for it to rally and continue up in the uptrend. Now, if it doesn't immediately just move up, move higher and go up, we'll just get right back out. We don't want to take a big risk on the entry. Now, once we get into the market, we'll hold our stops back and not suck it up in there quite so tight and let it run. But we need a market that's going to run. Yesterday, we took a couple of trades. We tried to get in. Market wouldn't run for us. So we tried 3-4 times to try and get into a market. Every time we got in, it failed. It wouldn't go for us. So we'll see if this will go for us today. And if it won't go, we'll just get right back out. I'm going to put that order that's trailing down there. I'm going to put it on that little green dot, which is the ATR. And so we're going to let that thing run up on the ATR. Let's see what it trail till break even on the ATR. For some reason, that's not jumping for me. That's going to wait one price bar. No, let's see. Let's go and add it again. I'm going to get rid of this so I can see what's going on. We're going to bring this full screen now since we're in this market. I'm going to bring it up full screen so you can see a little better. So we're long. We're looking for it to break above this previous high. I got to get my stop in there. So the way I'm going to do that, I'll just right-click on the order, say Add OCO, and then I'm going to program this. I'm going to tell it I want to trail on the ATR. And that's that little green dot right there. So we'll just leave it on the little green dot. You can see the little green dots kind of follow down behind the market, and that's a good place to put your stops. If this market will run and get up in there and break higher and continue this nice trend, then we can make some money. Right now we're up about $60, $70. We just need it to continue. We don't want it to flush back down, which oftentimes it does. It goes up and touches these highs. There's a lot of scalpers that'll take their profits right there. And it looks like that's what it's doing. That's the scalpers taking their money off the table. We're going to hold and see if it won't push back up. If it won't push back up, then we'll just get out, because the scalpers, like the market starts to run and then they take quick little profits, and they're happy with $50. And I don't like scalpers because they push the market back down right at opportune times to get in. So sometimes if you can't beat them, join them. You have to be a little scalper once in a while too. I have a strategy I call scalp and trail. So we can join the scalpers if we want to and take one off quick and do a quick scalp, cover your costs, and then try and let the other one run, see if we can't get a trend out of the market. But if the market won't trend, you can't make money. You can do a little scalping, but scalpers don't generally make money. The money is in the long trend. The money is in the long move, staying in the market for a longer period of time. We don't make a whole lot of money scalping. But this market doesn't seem to want to move. It's not moving in our favor. I'm not going to let it come against me. Just get out. Oh, look at that. We got right out at scratch break even. And I'm going to probably regret that and say, Lan, why did you get out? You should have just stayed in, because sometimes that happens too. And then the market starts to move and go in your favor and you wish you would have been in. Of course, you can always get back in. If it looks weak and like it's not going to do what you want, you can get out. And then if you want to get back in, you just get back in. Try and get back in. Maybe this market's going to go this time. Come on, buddy. I want to see you rock and roll. I hate this little dancing around. If we're going to go, we're going to go. Get off the pot. We're a little bit late getting in. We're going to anticipate a break above this previous high. Right here's where I generally like to get in. I like to get in and right on a break above that first green bar. So that first green bar breaking back up is the best place to get in, but we weren't paying a close enough attention to get in down there. We got in on a break a little higher. So I wasn't feeling comfortable with it. Still don't feel too comfortable with it. Come on, buddy, move. It's just being a little slow. There we go. That's what we wanted to see. A little pop. Pop up there and stay up there. Again, scalpers are going to start scalping right here. They're going to take this thing off because it popped above, and they'll pop up, take their position off. And that's what drives that market, pops it right back down again. It's just a whole bunch of scalpers trying to take $30 off. There we go. We got some buyers buying on a break above a previous high. This is our high for this market right here. So basically the high of yesterday too, or the bracket anyway. Come on, push up there. That's a nice trend. 1, 2, 3, 4, 5, or 6 bars in. So that's a nice trend. We just got in late. So we're going to join the scalpers. And if that thing touches that, there we go. We scalped out just $70. So if you can't beat them, join them. We'll just take some $70 off right there as it approaches that high. If it breaks above that, we'll look for another little ABC pattern. So there's your A pattern. There's your B pattern. So there's your counter trend. We should have got in right there. That's where you want to get in on these things, right there. Either right here, when you get the arrow, that's a good place to put your order in. Or if you miss the arrow, you're going to get in on the second run. Sometimes I'll miss the arrow on purpose and not take the first arrow, because sometimes the arrow fails, like right here. The arrow failed, came up, stopped you out, and then, of course, it didn't continue running either over there. Now we want to see it hold above that white line. Close above it. If it does, that's good for the market. It'll be bullish. It'll show a bullish sign. You see it close above there. Stay above there, baby. All right. All right. So what's going on down here? The NASDAQ is starting to try and go higher. So the NASDAQ will probably follow the Dow. So the Dow. So you watch the Dow run. The S&P, look at how these things are all just kind of being dead right here. Coming into a little triangle wedge formation, trying to look like it wants to break higher. You could put a risk on and try and take a long break out of that thing, see if it wants to break higher. We got the same thing here, but I'd rather see the market prove that it wants to go first before. I don't want to, you get lots of false breakouts in here. Get kind of a wedge pattern in here too, a little triangle going on, triangle pattern. I think there's going to be a really good article in Pitt News Magazine in the December issue on triangles and wedges. Aiden Gray is writing that article right now. I think we're going to try and get that into Pitt News Magazine in the December issue. He's a little late getting it to us, so we'll see. Look, there's your breakout right there. Let's see if it's going to break above that blue line. That blue line is the VWAP. We got a red arrow from the bulls and bears. That's a good signal indicating the market's turning bullish. There's our break and hold. It didn't hold. This is the first one breaking above that previous high. So we want to see if that's going to hold up there. It didn't hold on the first two, but it did hold the low. So the low never did break to the low. There's that Dow going up. Oh, look at the S&P breaking out of that triangle wedge formation right there. And it's really running. Oh, look, the bulls. NASDAQ's taking off. Man, why aren't you in? I'm feeling the same thing. A little FOMO here. Shouldn't have got out up there, right? But it started to pull back. We just scalped a little bit out. We'll just wait and see what's going to happen. Just watch. Getting in on those little red bars, that's kind of where I like to get in, right there. That's my little signal. That's my favorite place, right there. Of course, the arrows are always good too, but that was right at the morning bell. Getting in on the morning bell is a little scary. It always looks good in hindsight. You're like, oh, wow, man, that's obvious. Just buy the arrows. Okay, well, we'll wait for another arrow, but right now there's not one. Not an arrow. See, just buy and sell the arrows, Lan. It's so easy. Looks easy, doesn't it? That's why you're here, so you can do this yourself too. Beat Lan. That's the name of the game. You can out-trade me. I don't claim to be some great superhero trader. That's not why we're here. I'm a superhero teacher. Even Tiger Woods needs a teacher, right? Even Tiger Woods has a coach. I'm your coach. You be Tiger Woods. I'll do my best. I'll do my best. I'm going to do my best. I'm a little conservative. I've had these markets rip my wheels off, so I want to be careful, especially in front of an audience, right? You got to be careful. I'd rather be careful than be stupid. All right, let's go say hi to a few people. Let's see who's in the market, who's in town. Got Ben Corpus. Good morning, Ben. It's nice to see you. We got Bruce R. Nice to see you, Bruce. We got Michael Bruce in the house. Michael, great to have you. Michael's the one that's like, Lan, just look at those arrows. They work pretty good. They do work pretty good, Michael. That's why they're on there. All right, Larry McIntosh. Good to see you, Larry. Glad you can make it. Larry's from our class last night. And we got G Wiz. It's good to see you, G Wiz. Glad you could make it to class this morning. We got Gary Thomas. Good to see you. Oliver Rorman. So nice to see you, Oliver. We got John Mackey making it in the house. Making it to the class. Camille, it's good to see you, Camille. Glad you could make it. We got B. Taylor. Good morning, everyone. We've got Selena Pavlok saying hello. It's good to see you, Selena. Glad you could make it to class. We got Oliver Rorman. Nice software. It is nice software. Thanks, Oliver. It is some beautiful software. Rock Steiner. Good day, Rock Steiner. Glad to have you. Kirk Schwartz. Good morning. Great to have you, Kirk. We got Brian Johnson. Good morning, all. And we've got Bruce Merrill. Glad to have you, Bruce. Good to see you in class. We got Rock Steiner saying, what's a week or so ago, I noticed CSCO had a very symmetrical head and shoulders on the daily, but head and shoulders on the monthly chart. Bought a $50 January 19 put for $88. This morning it's worth $400. That's a score right there. Home run. Nice job. Turned $88 into $44 or $400. That's a sweet move in the options world. We're going to go over and look at our options here in just a minute. So stick with me. We'll go look at some options. Rock says, Yahoo! Good move, Rock. Nice. You love it when that happens, right? Let's watch the ponies just a minute. This is another opportunity to go long if we think this market's got some strength in it to take a third drive. So drive 1, drive 2, this would be the pullback, and look for a drive 3. Drive 3s are oftentimes not as strong as drive 2s. Drive 2 is usually the strongest. Drive 3 is the last attempt at trying to get one more push out of the market on a break above these highs. So we can come in here, and the way we get into this market is we just drop our trailing stop in there, our auto trailing stop on those red pullback bars in anticipation of one more leg higher. But oftentimes the market doesn't push higher. It just drops, and you're like, well, I was trying to go long, and the market's dropping. And then it's like, Lan, why didn't you take a short position? Well, because I'm looking for the market to go long. One more leg up. See if this isn't a bullish market. We got our bullish arrow, so we indicate the market's bullish. We're anticipating a rise in price. This is just a little profit taking in here. We're going to look for it to not break those green dots. If it breaks and holds below those green dots, then we throw this thing away. I like it to stay above the green dots, showing some strength. But if it closes below those green dots, then we have to rethink our strategy. I want it to stay above the green dots. Comes down, it spikes them. Takes out the stops of people who are trailing on those green dots. That's how you get stopped out. Oftentimes the market comes down, stops out, and then turns and starts to rally once again. So we're on the third drive high. We're looking for that 3 drives. The NASDAQ is still on the first drive. It's pushing up here. We'll see if we can't get a little bit of a pullback and another drive high. We're going to bring this line down, because if we draw a line on the screen, maybe the market will go to it. Okay, it's going to, now we want it to break higher right now. This is where we want it to go. We don't want it to wimp out and start going sideways. If it doesn't immediately turn and start to rally right here, we need it to go. It looks like the S&P is breaking higher. We got long. Now we need it to go. So we're going to come in. We're just going in with 1. If it would show some strength, we could put 2 on. I haven't been putting a lot of multi-contracts on. So we're going to take our stop. We'll put our stop. If it breaks low, we just get back out. Lose the money we made. We've got a little buffer in there, $70. We're going to risk that $70 to see if we can't make more money. But we got to have it rise in price at this point. If it keeps falling, then we just get back out again. But it broke the previous high. It went up, filled that order, tried to go long. And I just got my stop in there, sitting below those lows where it broke higher. So it broke higher right there and filled our order, only to come back down. So I got my stop right in here underneath this low. If it comes down and touches that, well, we're just going to get out, because that's not a good sign that it's breaking new lows. Higher highs and higher lows, lower highs and lower lows. That's how you have the definition of an uptrend, definition of a downtrend. So if it starts an uptrend and then fails, there's no reason to stay in. You could reverse your position and say, well, a failed pattern to the upside is a strong pattern to the downside. We could do that. And the way you do that is you come in here and say, well, I think this market might fall, but I don't think it's going to fall. I think what it'll do, if it doesn't go up, it'll just probably wander sideways. I doubt it'll flush like a toilet. I don't think it's going to make a big retracement. It might. It does that sometimes, but what I hate worse is when it just goes sideways. That's where it kills you. You can make money when a market rises. You can make money when a market goes down, but you can't make money in a sideways market unless you're trading options. There are ways to make money trading options in sideways markets. So if we get some good sideways markets, we'll make money in our options, and I'll show you how to do that. We're going to go over and look at the options that we've got in the stock market. Next week, we're going to start putting options in the futures market. So we will. And it's like, Lan, why aren't you trading options over here in the futures market? We will. We will. Stick with us. Come back. Join the class. Subscribe to our Pit News channel. Ring that little bell down there so you get a notification when I'm going to do the classes and what the classes are going to be about. So you get a notification in your email box. If you hit that little button, that little bell down there, that'll notify you. If you like these classes, go down and hit that little thumbs up thing. If you guys are enjoying the class, give me a little thumbs up. These are free. We don't charge you anything to come and join these classes. If you're in the university class, of course, you have to pay your tuition to get into the class at nighttime class, but these labs are free online. I wanted to be able to follow up to those classes and work with people in trading, not just teaching. So we're going to do a little teaching trading. So if you like what we're doing here, the only charge is a thumbs up. All right, come on, buddy. Push up there. Okay, the scalpers are going to step in right here, right up in this region here. Scalpers are going to step in. So do we want to be a scalper, or do we want to try and trade for the long haul and see if this isn't going to go up further? If we just want to scalp, right there's where we want to scalp. Take our scalp off right there. Okay, so now if the market pushes higher, people like to buy on a break above a previous high. So buy on a break above a previous high. So it's got to close above that previous high, just like it did here. Just like it did right there. Close above that previous high, and then we look for it to go to the next leg. Now, we had a good entry, kind of. I mean, it just gave us a 1-bar early entry. We got in right there. And this is the third drive. So the third drive oftentimes is not as big as the second drive. Doesn't mean it can't be as big as the second drive. It certainly can. Statistically speaking, the third drive is not as big as the second drive. So we scalped. We got out right here just as it come up and touched that previous high in anticipation that they might flush it down and then it would rally, but it's not flushing down. We'll see if it flushes here. The buyers that are buying on a break above a previous high are coming in right now. I don't generally like to buy on a break above a previous high because by the time on this third drive, especially because by the time you get your stop order to break even, the market is up here and it usually comes right back down and stops you out. So although it looks like a good trade, and you're like, oh, you missed it, Lan. You watch more often than not, it comes up and then comes right back down. About the time you get to break even, hits you, knocks you out. So be careful with that. All right, it's fall. It's making this little pullback right now, lower high. If we think that market's going to go and break one more high, give us that little pullback right there, we could try and get in one more time right in here in anticipation of a continuation of the uptrend. But that's just with a single contract. Oh, look at these other markets. They're doing. Why are we trading the Dow, right? Look at this beautiful little move on the NASDAQ. So the NASDAQ gave us that little pullback. The bars never went red on that pullback right there. So it rallied up. We got the arrow. We didn't get in on the arrow. So the first opportunity to get in is that little pullback, that little flag formation, right? You say, why don't you just trade the arrows? Okay, we can do that. But we only got one arrow. I don't have an arrow. So I missed that run, or I didn't get in on the arrow because it was the opening bell. So my first opportunity to get into the market was that little pullback right there. My second opportunity to get in the market was that little pullback right there. Same thing on this one. We didn't get in on the arrow. The market rallied. The first opportunity to get in is right here. Okay, so we didn't take a position on the NASDAQ, but we did on the Dow, that pullback right there. So that's your little flag formation. That's your opportunity to get into a market that's already running. So that's where you get in. And now it's running, it's making its second drive. So we got the second drive. So we're in the second drive, and then we'll look for another pullback. We'll look for another little flag in here, right? It's hard to get in when the market's running higher highs, higher lows, higher lows, higher lows, higher. It's really running that in there. So we need another little flag formation. We need a little hesitation in the trend, and that's what we're getting right here on the Dow. Getting a little hesitation. See how it pulled back against that? Now we're up there on the top of the third drive. So we got drive 1, we got drive 2, we got drive 3, and it's trying to break up out of that thing and make a little small run out and continue this drive 3. This would be a continuation of the overall drive 3. So this would be the C drive, and that would be a C1 would be right here. This would be C2. So that little marker right there would be C2. It's the second opportunity to get into the C drive. And if you don't know what I'm talking about, go get my playbook. It's out on Amazon. It's the manual to this class. Now, if you're in the class, the PDF is in your portal. You've already got it. It's the PDF. It's in the portal from the university. You can go get that book. And that's where we learn about all of these probabilities. All right. So that's the probabilities that I'm talking about here. And so this is a C drive. This is a C drive. So the C1 is right there. That break right there is your C1. So that's your C2 right here. Okay. The question is that C2 going to be big enough to get into and right up to the C3 and then the top? So usually we'll get a C2 and then we'll get a C3. And then the trend will be over and we'll look for the market to fall. Are we going to get a C3? That's the question. The C3 would be up in here on this C drive. So we need it to push higher, break above this previous high. That's your tiny little butterfly in there. Not butterfly, bow tie. Tiny little bow tie in there. And it's got to push above there. And the market's just moving in such small little increments. It's really hard to get in there and get an order in there and make it move far enough to be worthwhile. So now it's flagging down here. on the NASDAQ. We're getting a nice little flag formation on the NASDAQ. Now the question is, do you want to take it long? So this is your drive 1. This is your drive 2. Now we're going into, if it breaks higher, that would be drive 3. So this would be A drive, B drive, C drive. There we go. There's our break. How high? Well, it's going to have to go up, break above this previous high, and continue to break higher, and then come back and give us another little flag. So there's the rally. That's your opportunity to get in. Breaking above the high. It's not breaking up here on the Dow. So this could be a false breakout. Go up. Scalpers took their money as it came up, touched the previous high. Scalpers jumped out on the NASDAQ. So they pushed it up there, went up, took their $50 and jumped out. And that's why it flushed back down and didn't continue, because nobody jumped on with them and pushed it up, breaking above the previous high. Okay, now we're getting a failure here. So this is a failure of the C2. So the C2 failed, and it's looking like it wants to come down. If it breaks below those green dots, which it looks like it's going to do, it's going to close below the green dots. We're going to have a failure of the C2. If the C2 fails, we can start looking for a short position. And you want to take the very first short? Well, you can, because sometimes once that fails, it just drops. And you get lower highs, lower highs, lower highs, all the way down, 4, 5, 6, 7 bars, all the way back down to the blue line, down in here. Or you can say, well, it'll probably drop and then turn around, pop back up, because the short sellers will start to buy, the scalpers. They'll pull it back up. You get another little topping formation, a little 1, 2, 3 top formation, kind of like this. 1, oh, can't draw. It'll come down. Oh, still can't draw. Come on. It'll come down. Drawing backwards now. Ugh, I'm having struggle with the tools. Come on, tools. It'll come down, and then it'll come back up, and then it'll come down. So it's the back up that we're going to look for. Okay, that first drop sometimes, you can take it. There's your arrow. There's your arrow. You're like, why don't you take the arrow, Lan? Take the arrow. There's your arrow. We're going to let it run just a little bit down. Get rid of some of these drawings so we can see. Let the scalpers come in, start to buy again, and then we'll take the second drop. See if that happens. Sometimes you don't get the chance to get the second drop. It just flushes and goes. And then you feel FOMO again. You feel bad. You're like, why didn't I just take that? I should have just taken the risk. But the scalpers sometimes just take a small run and then it pops back up, and then you take the second one, and that's the one that drops harder. This one may not happen. Just decisions that you have to make along the road, right? How are you going to do it? You going to take the first signal, the first trigger right out of the gate, or are you going to wait for it to pull back a little bit and take the second one? I generally like to take the second one, a little bit more conservative. But then you feel bad when the first one works, right? That's just the nature of the beast. Coming down and touching that line we drew in there, which is this previous high right here. So that's your bow tie, tying off. Look at the NASDAQ, or the Russell down here, making a beautiful little, once it started to go, it made that ABC pattern, dropped all the way down. That's all the way down here to the Fibonacci 200% projection level. That was a nice move. Where's Matt? Matt probably made a whole bunch of money on that one if he's trading, if he's here. Okay, this mark is pulling all the way back. It's going to come down and bounce off that. Let's see what it does with that blue line right there. A lot of people think that blue line's important, so it might have an effect on the price. Okay, we're getting a pullback here on the NASDAQ. Is it going to pull back right now? Now the NASDAQ might give us that little ABC we were looking for. A little downtrend, get the little pullback, and then the drop. Maybe we can trade the NASDAQ. Look for the NASDAQ to pull back. There's the pullback on the NASDAQ. course, then you look at that and you're like, well, this is the C drive. It could be the next C drive up, and it might take off and go up one more drive too. How do you know? You don't. You don't know. You just have to decide where you're going to take your position. And then if it doesn't work out, get out. I'm going to anticipate this thing's going to go up. Test this high. Oh, it's breaking through it. Let's see if it'll hold above it. I thought we might get a drop just like the Dow. I thought this would follow and come down to this blue line. Instead, it looks like it wants to break higher. Lan, why didn't you take that? Well, because I thought it was going to go down. I thought it was going to come down here, and I thought it was going to take a short position right here. And it popped up and went long. See if it closes above that high. I don't like to buy on a break above a previous high. I explained to you earlier why. Because oftentimes a break above a previous high doesn't move far enough to get your stop to break even before it turns around and comes back down. You want to get into these valleys. You want to get into these little, if you're going to take the long position, you want to get in right here. So this is the third drive. So we drive 1, drive 2. I thought the drive 2 was going to fail. And there it still might. So our short position would be on a break below the previous low, which would be this arrow, this line. But that's in this market, that's a lot of money. Okay, we're short the NASDAQ in anticipation of that topping failure. Now we're going to look for it to come down and touch this blue line. It's got to break this. It's got to break this point right here. And there's going to be scalpers that are going to grab onto it right there. Scalpers are going to come in and they're going to test that low and they're going to take their positions off right there. They're happy with their $100. We could be happy with our $100. We could just scalp it out right now and take another $100. We'd be at $235. Just doing a little scalping today. But we're going to let it run. We're going to let it see if it's not going to go a little bit further. It's got to hold below that low, and I want to see it come down and test that blue line. So we're risking the $100 that we got into it. Now, if our goal was $500, we would add our OCO, and we're just got a single contract in here. We're up 135, so we need $380. So we put our $380 in there. We'll put it at 4. We could put it at 400, 390. If it just comes down and touch, now it's pulling back against us. We just need to come down and touch that 390, and we'd break over our $500. We'd have our $500 for the day. But it's pulling back. The scalpers stepping in. They took their little bit of profit. Now they're pulling it back up. They're buying because they're selling. What they're doing is they're getting out of their short position, right? So they sold to get out. They have to buy. So they start to buy. That's what draws the market back, has these pullbacks. Doesn't mean that people are buying to go long. It means they're getting out of their short positions. So oftentimes that'll pull all the way back to our entry point. It makes you feel bad because you were up $280 and you're like, well, why didn't I just scalp it out? Well, because I was looking for it to go longer. I wanted to go farther down. Okay, there's our signal for another short right there is what we were looking for on the Dow. That one green bar pulled back and then it's starting to drop again. So we'll look for it to come down and test that blue line once again. So we're holding tight on this. This is another opportunity for us to put another short position on. We could put a second one on if it breaks below that low and look for it to come down. That'd be dollar cost averaging into a position on that little flag formation. So it's a little flag. Looking for it to fall some more. Okay, now we're short 2. And we want to see it break that low and push past that low. Right there, we want to see it push past that low. If it can push past that low and hit our limit, we'll just get out. Or you can stay in. This is a scalping trail right here. We got our single contract. There we go. Oh, it almost touched it. Look at that. We'll take it. Okay, we scalped one off. Now this is the trail. Okay, so we picked up we're up $392. Now we can just drop our order, stop in here. We're going to risk, there's $250 in there right now between where I got in and where it's trading. So if we wanted to we'd be out with over $500 if we took it off the table right now. Let's do that because I'm going to run out of time here. So we're over, that's $600. All right. There's a $600 little morning session. Took us 45 minutes to make $600. That's not too bad. You know what we didn't look at this morning? We didn't look at our trading economics news. What's going on right now? It's 8 o'clock. 8 o'clock. 8 o'clock, we had housing market index came in. Previous was 40, actual was 34, consensus was 40, forecast was 41. At 8 o'clock, we came in with a lower number. So that was bad news. Maybe that's what caused this market to do a little bit of flush right there at 8 o'clock. We made some money on that. We didn't even know why. We just watched the patterns. So that was a bad news on the housing starts. Right there at 8 o'clock. So it ran up and then turned and fell right back down at 8 o'clock. Good thing we took our money off. Look, it's backing off here on the NASDAQ. We'd again been getting stopped out, losing our little bit of money. So you never know. You don't know. It could still hold. Nope, just broke those green dots. We'd have been out. So we scalped it because it started to show weakness and started to come back. I was watching that little tiny chart up in the upper right-hand corner, and it started to show weakness up there. Oftentimes, if you go watch some other traders, they'll say, I'm watching green on the tape, looking for the tape. I'm a tape reader, green on the tape. Well, we don't have a tape here. We have a little chart. We take that same information that they're looking at, the old-fashioned way of doing things, because we don't do the tape over here. We use a chart instead. We chart the tape. So we have a tape. We just don't look at it as an individual orders. We look at it as a chart. So we actually chart the tape. And that's what's going on up here in the upper right-hand corner. That's the tape. So if you hear somebody yelling on, there's green on the tape, buy, buy, buy. That means this little chart up here in the upper right-hand corner is starting to rally. Okay. So that's what that means. And so, it's red on the tape. It's red on the tape. Tape's going red. That means lots of sellers are coming in. Well, our little chart would show that the market would be going down on the chart. So we actually chart the tape. We don't just have red and green colors. So it's a little easier to see a chart. We're used to seeing charts. That's what we've been trained to see. We know an uptrend, we know a downtrend, and we can see that the market's continuing making higher highs and higher lows, even on the tape, even on the little tiny chart. Every single trade is being charted in that little upper right-hand corner chart. That's what that's for. All right. So you're watching the tape. So you sit here and look at the tape. You're seeing that this chart right here is dropping. Well, the tape is dropping. So you're seeing all the individual charts. You can watch it over here on the big chart, or you can watch it over there on the little chart. It's just more granular on the little chart. That's all that is. There's green on the tape. There's green on the tape. Oh, there's green on the tape. That just means that the chart's going up. That's all that means. Okay. So we chart the tape. That's what the tape is. Okay. Selena is saying, Lan, did you do a lesson on how you have your chart set up when you started your lab videos? Actually, I did, Selena. It was a while ago, though. This is the 50. We hit 50 on, was it Tuesday? This is when, so this is 51, 52, or Monday was 50. We've had 52 charts, 52 markets. So it's kind of hard to, keep repeating the same thing over and over as we go through classes. And so I apologize that I, have my chart set up and you would have to go back through and look through some 40, 50 hours of work to try and find where I did that. So I don't expect you to do that. That's difficult. So if you would like to have me help you set your charts up, I would do that for you one-on-one. You can just come and sign up. How can I show you that? I don't have a way of, I can do it right here on this software. If you want to work with me and I will just set up an appointment, I will call you on the telephone and we will hook up and I can see your screen and I will help you get your chart set up. My calendar is https://lanturner.setmore.com. If you go to that, that's my calendar, and you can have one free bowl session. That's how that works. And you and I will set your software up. And that's what that bowl session is for. Anybody in the whole world who wants me to help them set their software up the way I have mine set up, all you have to do is go to that lanturner.com or lanturner.setmore.com. That's my online calendar, and I will help you set your software up. Anybody in the whole world can have a free bowl session with Lan Turner, and I will help you set your charts up the way I do it. All right, so feel free to come and do that. I've done that with several other guys in here. I was on the phone with Michael Bruce. Michael Bruce and I were talking about our software and talking about the markets, and he came and set up on that. And so feel free. I do that for the university students, of course, have unlimited. If you're with the university classes, you can come and sign up as many times as you need to. As long as you're in my classes, you can come and we can work together. That's what the advantage of being at the university. But you guys who are on YouTube, I give you a free one, no problem. If you want to continue after that, of course, my time's valuable, so there's a little fee that goes along with it. But the first one's free, no problem. I'll come and help you get your software all set up, and then we can come back and you'll be all ready to go here. Now, I can take some extra time to show some neat little features that are in the software and help you get some of the things set up, because the whole class would like to see that at some point, but there's some guys who don't need that. Guys who are here to learn a little bit about options. So let's go. Oh my goodness, look at this. I told you it was going to come down and touch that blue line, didn't I? Right there. So it made another little flag, pulled back after we got out, and made that little flag. You could have trailed up and then taken that next drop. That next drop was actually just as good or better than the first one. So we could have got in right there. That would have been our entry right there to another short side. Down it come to the blue line, another $395. I'm sure there were some guys in here who got that, right? Anybody catch that? I was blathering and talking and missed that trade, but that's all right. I'm done trading for the day. I'm going to go over and we're going to start talking about our options now. We've done our day trading, so let's go talk about our options. That's what these guys are in this class for, set up to do their options trading. So, all right. This is the stock market. This is where we put our options on yesterday. And so we're going to come in and we're going to talk about this. Now, last night in class, we talked about these different markets, and we're going to come in and look at them one at a time. The first one we're looking at is Apple. So let's clear this up. We're going to say multi-leg chart only. So we're going to go to the chart. So, this is Valero. We want to go to Apple. Okay, here's our Apple trade. Now, we put on 4 call options because we wanted to look at the differences between the call options. We wanted to look at the difference. We wanted to look at an in-the-money option, an at-the-money option, an out-of-the-money option, and a farther out-of-the-money option. So these are all call options. Now, when we put this one on right here, this one in the middle, this 185 call, that was at the money. Now it's in the money, all right? So if we come down here and look, that 185 call is right here. That's this one. It's up $160. Now, I want you to remember, when we're talking about options, a lot of people get confused because you have the options premium, which, remember, is kind of like when you're buying a house, it's kind of your earnest money. So that's what you're putting down, the premium of the option. But when we're trading options, we have the right but not the obligation to exercise the option and take the stock, the underlying stock. That's what an option is. It's the right but not the obligation to buy the stock at the price you specify. So a 185 call means I have the right to buy the stock at 185. Now, when we trade options, For the most part, we don't really plan on exercising our right. Now, there's times that we will, and there's times that we can, and it makes sense to do so. And we'll talk about that in the future. But right now, we're just going to talk about the simplest form of it, which is we're just going to use the premium of the option. If I come over to the options chain, and we're going to come out, and these are all 64-day options. We're going to look at our 64-day options chains. So we can pick whatever time frame, right? Whatever time we want, and then you're going to have a whole table of options for that time frame. So right now we're using 64 days, which means that our option, our right but not our obligation to buy the underlying stock, is there for 64 days. We have 64 days to exercise our right to buy the underlying stock. But for the most part, we're not going to do that. Why not? Well, because we'd have to come up with, in this case, $18,542. And I don't want to put $18,542 into the stock market. Why would I have to come up with 18,542? Well, the reason I'd have to come up with 18,542 is because each option represents 100 shares. They don't have options for 20 shares. They don't have options for 50 shares. I wish they did. That would be cool, right? Hey, I just want to buy an option for 20 shares. Nope, can't do that. The minimum increment for options is 100 shares. And why do they do that? Well, because we're not really, for the most part, going to be exercising our options and buying $18,000 worth of the underlying stock. We're just going to trade the value of the option itself, because the premium that we have to pay for the option when we buy an option is this table or this line right down here, this column. So you can see at the money, which is the one that's right at where the market's currently trading. So the market's currently trading at 190.55. So a 190 call option would cost us $690. I want you to think about that as your investment amount into Apple. All right. You are investing $690 into Apple. That's how I want you to think about it. Don't think about it as, oh, I have the right to do $19,000, and so that scares me. I'm not going to trade options. It's too much. Well, you're not going to actually have to put up $19,000. All you have to do is put up the premium. And then if the market rises, that premium will increase in value. If the market falls, the premium will fall in value. And that's all you're going to trade. You're just going to trade the increase or decrease of the premium itself. All right. So that's really your investment. So the fact that you can exercise your option and take $19,000 worth of shares if you want to, that's always there if you would like to do that. But that's not how we're going to do it. What we want to do is we just want to think about the premium of the option as our investment into Apple. We're going to invest, in this case, at the money, $695 for an at the money call. Now, when we bought this one, it was at the money, 185 calls. So it's up, it's making us money. So how much is it making us? Let's come back over to our positions. And you can see our gain in here. We've got on this 185 call, which is the one right here that was at the money when we put it on. Our cost basis was $870, so we paid $870 for it. It's up 18.97%, or $165. Now that's really cool, right? We bought that call option. It's up 18%. That's amazing. Most guys will say, man alive, I put $100,000 into the stock market and, or into a savings or a bond, and I'll wait an entire year to make 5%, right? We'll wait an entire year. Oh, that's a good investment. I got me a CD down at the bank and it's making me 4.9% interest. And I only had to lock it up for 6 months to get that 4.9% interest, right? That's the advantage of options, is that they have high leverage. So you can make a lot of money because you're controlling, basically, you're making, controlling for the most part, you're controlling the 100 shares that you have the right to buy at that price. And if those 100 shares go up in value, you're basically making that amount of money. Now, it's not quite that cut and dry because we have Delta, and we haven't talked about Delta yet. We're going to get into Delta. We'll talk about Delta tomorrow. So don't miss tomorrow's class. Those of you who are at the university, we have our next classes on Friday. We're going to talk about Delta on Friday. Maybe we won't talk about Delta here until Friday either, because I don't want to get this class ahead of that one. This one is supposed to be teaching what we learned last night. So thing is, I teach 3 classes at the university and I teach 5 classes online. So we can go into greater detail into the things we learned last night. One of the things we learned last night was this right here. So we're going to go into this. We'll do the next 3 or 4, and we'll go look at a couple other markets. And then we also learned about selling options. All right. So we're going to learn, stick around here for another 10, 15 minutes with me, and we'll learn about how to sell options too. And we'll go do a few of those. So this is the 870 at the money. It's up 17%. All right. So now we're going to go look. We made $150 on that. And now let's go look at the one that was in the money. Let's go look at this one that was deep in the money. All right. So it was already in the money. So we had to pay the difference between how much money profit there was in there. So it was this one and this one. There was already $1,000 worth of what we call intrinsic value. All right. Intrinsic value. So there's options are made up of 2 kinds of value. We have intrinsic value, which is what we see here. If you buy an option that's already in the money, right? You bought it when the market was trading above the price, so it's in the money. This one was in the money by $1,000. So we bought it right here, but the market was already trading way higher. So it had $1,000 of intrinsic value. So we just had to pay for that. That's why that option was so expensive. So we had to buy that intrinsic value. That's why oftentimes we don't buy in the money options, because why would you put up $1,000 extra that you didn't need to? You could just buy the at the money and not have to buy an extra $1,000. That's why we don't buy in the money options. So your cost on that was $1,655. So that's that $1,000, right? A little bit, not quite $1,000, but you can see in there, the at the money was 870, right? Yeah, the at the money was the 870, 185. Yeah, that's the one we were just talking about, the 870. And so this one is almost $1,000 more. So there was $1,000 of intrinsic value built in there. Why would you do that? There's really no reason to do that. There actually is a reason to do it, and I will teach it to you tomorrow. It's going to be delta. And that would be the reason why you might buy some in the money options, okay? Because you want a higher delta. What is delta? We're going to talk about that tomorrow. All right, so that's your intrinsic value. That's the difference. That's why that one cost is so much more expensive. But look at the gain, 10%. It's 10% on $1,655, which is not as high a percent. This one was 16%. This one was 10%. But 10% of $1,650 is more money, more cash, than 17% of $870. So you can see $870, the 17% was $150 in profit, but the one that you paid $1,655, that was a bigger investment into the market, right? You made less percentage, 10%, but the gain was $175, more dollar amount, a greater dollar amount. So you have to weigh that out in your mind. Which one do you want? And we're going to talk about, again, as we go through this class, we'll talk about different reasons why you want to do one versus the other and the advantages and disadvantages. So the next one is down here. We're going to go look at the 195 call, which is this one we put on out here. Now, this was out of the money. Now, the market's moved towards this. It's moved in our favor, so it's an out of the money option. We paid $325 for that one. And because it was out of the money, it's a bigger risk, right? You're taking a bigger risk that the market may not go up there. But this market just kept trucking on up there, which is really cool. So we paid $325. Look, we made a gain of 28.46%. Again, can you get that in a CD at the bank? In what, 2 days? 28% in 2 days. That's pretty cool. That's why options are awesome. 28% in 2 days. Most guys would wait 2 years to get 28%, maybe 3 years on their money to get 28%. That's why you don't have to overtrade options, okay? An option is something that you hold very close and dear to yourself, and you wait until you get just the right setup and just the right time. You put it on, you let that baby run, and you can make 100, 200% on your money and just knock it out of the park compared to what you could get putting your money in some sort of a savings account. This is why what we're doing here is we're trying to build ourselves a little hedge fund, right? So the whole idea of what we're doing at the university is I'll take you through different levels. We started off with just a little using the stock market as a savings account. Then we talk about different ways we can use that as a savings account. We go to the next level and we start trying to make our savings account work for us in better ways. And so we start learning how to read the market and try and strategically time our savings account as opposed to just dollar cost averaging in over a long period of time. The next step beyond that is to say, well, I want to build myself a little hedge fund. I want to have some money in here, and I want to see if I can't really capitalize on it, beat the market, and really do well. So then we start trading the stock market, and then at this point, now we're like, well, we really want to capitalize on it. We want to go to the next step, and we'll build our little hedge fund, and we're going to use options, because options can really just bring our little hedge fund really up very significantly, very quickly. But we need to be very careful with them, because if you can make a lot of money fast, you can also lose a lot of money fast with options. So we start getting into this a little bit more conservative option strategies. All we're doing here is exampling the purchase of 4 different options to show you what they all do, one against the other, being deep in the money, at the money, out of the money, far out of the money. So let's look at the far out of the money one, which is right here. We only paid $79 for it. That was your total investment into Apple. So remember, your investment into the market is the maximum amount of money that you can lose when you buy an option. So if I put $79 in there, that's the maximum amount of money I can lose. So if you're like, well, I can't afford to buy an option for $870 at the money, Lan, well, don't do it. Scoot out a little bit farther and buy one a little bit cheaper. You can see that the amount of money that you invested, they all went up. If you were right in your direction pick, all your options went up, every single one of them. The one that was deep in the money went up, the one that was at the money went up, and these that are out of the money, they all went up. They all just went up varying degrees of percentages. The greater risk that you take, the higher percentage you're going to make, and the lower the cost is to put the trade on. So if you got a small account, you can buy these options and avoid the day trading. Let's say you got $5,000 in the stock market. Well, you can go buy options, and you can't buy and sell them the same day. That would still be considered day trading, but you don't generally plan on, holding an option for 10 minutes. Now, not that you can't. We're going to go over to the futures market, and because we're day trading in the futures market, we're going to start putting on options on our day trading, and we're going to only hold them for short periods of time. And I'm going to show you how to do that too. So, but in the stock market, if you got a small account below 25,000, you can't day trade. You're not allowed. You have to have at least $25,000, $30,000 to day trade in the stock market. So if you don't have $30,000 to invest into a day trading account, you can do it with options, and you can come in here and you can say, well, if I can only afford to buy 1 share. Well, if you buy 1 share, that's $200. That's a $200 investment into Apple. And then if that 1 share moves, it's going to have to move from, $200 to $209. That's a big move. You're only going to make $9. It's not, it's like, you got to have $20,000 to make any money in Apple. You got to have 100 shares, right? Or it's not going to be worth it. So you can't afford $20,000. Otherwise, maybe you can. Depends on a lot of guys. So I'm talking about smaller accounts right now. So you can do it with options instead. And that's the point I'm trying to make. You can invest a $79 option. You can buy a $79 option and make the kind of money that you'd be making if you had bought 100 shares, right? So this is a $79 investment, right? It's the premium of the option, and it made 36%. That option made 36%. Now, I know some of you are going like this, and you're like, well, the one that was far out of the money for only $79 made 36%. The one that was in the money, deep in the money, $1,655, only made 7%. Why don't I just buy, I've got $1,000, I'll just buy 100, or I'll just buy 10, or I'll buy 100 of those $79 ones and make 36%. Okay, do that. All right. Can you see the advantages of options? Of course, bigger risk, bigger reward. So now you have the gain of a $79 option is only $29. So the dollar amount is smaller because it's a smaller investment. You only invested $79. But the gain was 36%. 36%. That's killer. $29. All right. So now you, of course, add them all up together. We made $325 up so far, or 11% on our $3,000 investment. So we've invested in here. You can see the totals down here, $2,929. It's up 11% combined. And then you've got $325 total. All right. So that is our Apple trade. Let's go over quick, and we're going to look at our, what was the other one we had? We had a Meta trade. So let's go look at Meta. All right, Meta This was just a single put option. This market pushed up really high, and man, we nailed it, didn't we? We picked the, well, not quite the exact top. We missed it by 1 day. It made a higher high, but it closed lower than where we got in yesterday. And then today, it's flushing back down. So let's just go to the chart, our meta, and this is a put option. And we bought a put option at the money. Now, it would have been fun to have 3 more on there, right? One up higher, one in the money, one out of the money, one deep out of the money. But we didn't. We just put on one because we were just learning how to put on a single option. We put on a single option. And that one option right there, we paid, how much did we pay for it? $1,430. So it was a $1,430 investment into Meta to the short side. And all we had to do was put up $1,400 and we're up $322 or 22%. We are up 22% in 2 days on this option. We picked the right direction. What if we'd have bought a call right there? Well, we'd be down $325 had we held on to it. Now, the maximum amount of money we can lose is $1,430. Obviously, we don't want to wait for it to lose $1,430. The market would have to move quite significantly against our position to lose it, and it would have to, clear down here at the expiration point. So let's take our our premium, $1,430. $1,430 would be right there. 1,400, that's about as close as I can get to it. So that's our line. So this market would have to be below that line right there at expiration. If it was a call, and we'd lose our money, we'd lose all of our money. We'd lose our entire amount of money. But as long as it was above this line, we wouldn't lose all of our money. We just lose some of it. Okay, so that's the game you're playing. You got this much time for it to be above if it's a call. But since it's a put, it's the other way around, right? So we're going to do it as a put. So a put, we're going to take our $, and this is a put. So a put means that you buy a put when you think the market's going to fall, and that makes money on the market going down, which is what the market's doing now. So we bought this put. We're up $292, and we invested $1,430. $1,430. That's about as close as I'm going to get it right there. So our line is from this one here to here. So as long as it stays below that line, right, that's where you would lose all your money. Okay, now the break-even point, where it's got to go to break even on that line, is the same thing. So the same thing, you'd come down here and you draw your $1,400. $1,400. And then that line that I just deleted, the market would have to stay below that line to stay profitable. Okay. So as long as this market stays below this white line that I've just drawn in here, all the way here, as long as it stays below that line, you're going to show a profit. But as soon as it goes above that white line, that's where you're going to lose money. So you can say, well, Lan, I think that this market's going to pull all the way back down here. Well, then you would hold on to it as long as you could. As long as it's down in this region, it's going to make money. All right. It's going to be profitable. As soon as it goes back up into above that white line, that's that arrow right there, that's where you're going to start to lose money. And when it goes up to here at expiration, you're going to lose the entire amount. Well, you bought the call, so it'll lose the entire amount if it's anywhere below that green line. So it only has to be that green line right there. If it's below that green line, you got money. So, and anything below that white line is profit. So this is all profit, all profit, all profit down in here. Okay, it's just got to stay below that line. And right now it's below that line quite nicely in the beginning. So you're up $277. Do you want to take your $277 right now, or do you want to get out? What do you want to do? Do you think that Meta might turn and start to go back up? So if it now catches and starts to go back up, and it goes back up above that white line, you're going to lose money. That's really the name of the game. Okay. So anything below the green line, still have a little bit of profit at the end, but not a lot. You're going to probably lose some money. But right here is your break even. So it's got to be below that line right there at expiration to just break even. All right, let's go sell some options. How are we going to sell some options? Let's do a little academic work real quick here. Okay, options trading, just to highlight or cover what we talked about last night in class. We're going to talk about selling a put or a call. If we think the market will go up, we sell a put option. If we think the market will go down, we sell a call option. That's just the opposite of what we're doing when we buy a put or buy a call, right? If we buy a call, it's because we think the market's going to go up. If we buy a put, it's because we think the market's going to go down. So if we think the market is going to go up, we would sell a put. And if we think the market is going to go down, we would buy a call. So that's the directional. It's just the opposite direction. Okay. So I know it gets a little, you've only got puts and calls. There's only two options, but you can buy a call and you can sell a call. You can buy a put and you can sell a put. If you buy a call, you want the market to go up. If you sell a call, you want the market to go down. If you buy a put, you want the market to go down. If you sell a put, you want the market to go up. All right, that's how you make money on these. That's how it works. Pretty simple. Let me move myself out of here. An option seller or writer has the obligation to sell the underlying asset contract at a specified price, the strike price, before a specified day, the expiration day, for a specified cost, the premium. An option seller must have a margin account to cover the selling of an option. No margin accounts or margin required when buying options. Now, we talked about that. A margin account is basically you're borrowing the money, right? You have to have a margin account to sell options. You don't have to have a margin account to buy options. So a lot of you guys maybe have a retirement account and it's not a margin account. So your margin account, they don't let you have margin accounts in most brokerage firms don't let you have a margin account when you have a retirement account. So you're just doing cash counts. So with a cash account, unless you can do it. You can go and you can get your a margin account in your retirement account if you want to. There's brokerage firms that will let you do that. Okay. So you have to have a margin account if you're going to sell options. And if you're going to put on option strategies like an iron condor, then you've got to have a margin account to do that because it's a combination of buying and selling options. It's a little bit more advanced strategy. And it's one that we're going to do over in the futures market. We'll do iron condors when we day trade. We like iron condors for day trading. Okay. So let's see. Next thing here I want to show you. So let's go in and sell a couple of options. Okay. We're going to sell a call and we're going to sell a put. And we're just going to put them on so you can watch and see what they do. Okay. So let's go do that. Okay. So let's do that. We're long this market. So let's go in and we're going to sell an option. Now we're going to sell a call option. And the reason we're going to sell a call option is because we think the market's going to go down. That's why we bought a put. If we think this market's going to continue to fall, we could sell a call option and that would make us money, right? Oh, we'll do the same time. We'll do 64 days and we're going to sell our call. And we're going to put that up there. And how much are we going to sell it for? We could sell it for, there's $500. So why would we sell an option? The reason we sell an option is to collect the premium. Now, when you buy an option, you have to pay the premium. All right. So the premium is the amount of money that you're investing in the market. So if you're going to invest $500 into the market by buying a call option, right, we're going to think of our premium as our investment. Well, whoever sells you that option gets to collect the premium. So that's what's really cool about selling options is if I sell this call option right here and I think the market's going to go down, they're going to give me that $525. So I get to collect the premium that somebody is buying that call option for. They're going to buy that call option. And you're like, well, why would anybody buy an option way out there? Well, I just showed you why, because the return on those options that are way out a long ways away, they earn a lot of money, right? So somebody's going to be buying that call option up there and we're going to sell it to them. And so when we sell it to them, we're going to receive $525. They're going to pay $525. That's their investment into the market. We get to receive that $525. But remember, when they buy an option, they have the right but not the obligation to buy the underlying stock at in this case, $360, which is way out of the money. So if the market rallies, they're going to make a bigger percent increase. Well, who gives them that percent increase? We do, because we're the ones selling them that right. So if they have the right, but not the obligation, and the maximum amount of money that they can lose is the $540 premium that they paid, and we're the ones giving them the right, we have unlimited loss potential. They're going to give us $545, but we have unlimited loss potential. We could lose money as long as that market wants to go up against us. All right. So that's the idea of selling options. So that's why we put on combinations of options. And we'll get into that in a little bit later, but we can then use some of the premium that we receive to buy another option as an insurance policy against having unlimited loss. Okay. So that's where we're going to get into tomorrow. We're running a little bit late on class today, but we're going to come in here and we're going to sell a couple of options. We're going to collect $545. Now, the $545 is also, once they give it to us, the only way we can keep the whole thing is through time decay. So we have, the way we make money is by having that option decay in time over the time up to that purple line. So if we liquidate before that purple line, we don't get the full $545. We have to give some of it back, right? So they give us $545, but then we owe $545. So you have both a credit and a debit. We're credited with $550, but we also owe $550. So they give us the $550. If it then dies in value to, let's say, $250, we still owe $250. If we liquidate the position, they gave us $550, we have to give $250 back. That's how that works. It's kind of the credit debit spread thing. It'll make more sense as we do more of these. I know it's a little confusing when you first start thinking about it, but it'll make more sense once we start doing them. All right. So just stick with me. Keep coming back to class. I know it sounds a little complicated. I have to teach you lots of things. I can only teach you little slices of what we're doing here at a time. And so I teach you what I can, and then tomorrow we'll teach a little more, and then the next day we'll teach a little more. And then when you get all of it together, it makes a lot more sense. So we're going to just keep doing it over and over and over again, and your exposure to it will make it easier and easier and easier. So we're going to go ahead and we're going to sell this one for $500. Let's go ahead and see if we can get into this one. And we did. Okay, so we did it. We sold it for $500. We just made $500. Now, we still owe $550 too. We made $550, but we also owe $550. So if you come down here, our position, you can see right here, it shows that we are actually down $5. That was the cost of doing business. That was the spread. But our cost is, see, a negative $550. So we bought this one here for $1,400. We just sold one for $550. And so that makes our total investment down here of $880. So they completely just gave us that $550 right now. It's in our account. Boom, we got $550. That's pretty cool. So our cost of doing business just got reduced on that $1,430 cost of an option down to $880. See how that works? So they give us that $500. Now let's say well, Lan, I want to take that $500 home. So let's go ahead and liquidate this position, get out, take my $500. No, it doesn't work that way. They gave you the $500, but you also owe $500. Okay, so if you liquidate it right now, you're going to have to give them back the $500. Well, how do I get to keep the $500? Well, it's through time. All right. Every day they're going to give you a little bit of this money. Okay. Every day. We got 64 days until expiration. Every day they're going to give you a little bit of money. Well, how much are they going to give me, Lan? How much are they going to give me every day? If you come down here and look in the options chain, we got a column that tells you. Okay. You're going to make about, in this case, $848 a day. $8.48 a day. Every day that this market stays below that red line, they're going to give you roughly $8.48. Now, it's not exactly that amount of money. This is just a straight line. And then it's actually a curvy line. So, but this is a rough estimate of how much you're going to get every day, $8.52 every day. So you're like, well, I want to hold on to it until the very end so I can make the full $550. Okay, we'll do that then. As long as the market stays below that red line, you get to keep all that money. Okay, so if the market can rally all the way up to right here, you get to keep all $550. But the name of the game is, if it goes over by 1 penny, you lose all $550. 1 penny is all it takes to go over that red line, and you lose all $550. Why? Because the guy who you sold it to gets to take that profit. He gets to take that profit. So you will need that market to stay below that red line. And the longer it stays below that red line, the more likely you are to collect your premium. Now, if the market starts to rally right here and go up, you're going to start to lose money. It's going to show that you're losing money. But it doesn't matter as long as it stays below the red line. As long as it stays below the red line, it's got to hit that purple line before it hits the red line. That's the game you're playing when you sell options. It's got to hit that purple line before it hits the red line. If it does that, you get to keep your full 550. All right. But not so on the call option. The call option, it can go up and down, and it's going to lose or make money in the direction of the market. Okay. So it'll work out. You'll see. We'll do a few of these, and it'll make more sense as we do them. So back to our positions. So we got 2 positions in the market. Our 550, our market's actually dropped since we bought it already, and we're up $20. They've already given us $20 on our option that we sold because it's going to make and lose money based on the movement of the market as well as the decay. So remember, we got 2 different kinds of value. We got intrinsic value and we got extrinsic value. So the extrinsic value of the $550 is the movement through time that we get like $8, $9 a day, or the market can move in our favor and it can give us some of that extrinsic value, and it'll give it to us faster, or intrinsic value. It'll give us more money faster. So if you want to just take your $15, you could just cut it right now and take your $15 off the table, and you made $15. So that's 2.73%. That's about what you could get in a CD for a whole year on $550. So that's pretty good, right? So what am I missing here? I wanted to say something else. Oh, the maximum amount of money you can make when you sell a put, though, is the premium, that $550. All right. Because the profit potential of your call option is unlimited. You paid, in this case, we bought a put, so we paid $1,430, and however far this market can fall before that purple line, that's how much money you can make. Unlimited profit potential. But when you have a put option that you sold, the maximum amount of money you can make is $550. So if the market falls hard in your favor, they might give you that $550 quicker, more sooner than if you you might not have to wait all the way until the purple line. But it will decay faster if that market falls against your position, and they'll give you your money more quickly. But otherwise, if it rises, you're going to show a loss, but it's got to just stay below that red line to get your full $550. All right. I know, a little bit complicated because they have a little bit different rules for calls and puts, but the more we do, the more easier it'll get. So let's go over and let's see, what else have we got? So we had Apple. We looked at Apple. We had Meta. We looked at Meta. We added that on that position. We had Amazon. So here's our other Amazon. Now, Amazon we went through, and this is the one where we have 3 options on here. And these are all put options. The others we did all call options. So this is in the money on the or an at the money on Amazon. This is an in the money on Amazon. Right up here, the one above is in the money, right? That was the in the money, and the one below is the out of the money. And so at the money, if we come in here and just look real quick, we paid, that was a 145 call because it's trading at 145 when we bought it. So it's the 145 call, and you can see right here, 145. So it is our cost basis. We paid $570 for it. It's gaining 19.3%. Pretty darn good. That's a $110 profit on that one. Okay. So that's your Amazon 145 at the money put that we bought. So we bought a put, so the market has to fall to make money. So that's 18% return on our money, or $107. The one that was out of the money, the 135, out of the money, we paid $239 for. So that was our investment into Amazon, $239, and it is up 22% right now, or $53. So 22% of 239 is $53. Okay, that's those 2. Now we have the in the money. Now the in the money, we paid $1,225. That's this one up here. Okay, $1,225. And it's up 11%, or $145. Okay, So bigger risk, bigger reward. Bigger investment, smaller risk, smaller reward. So that's how it works. Okay, so $1,225 investment in the money, deep in the money, 12%. $239 investment, far out of the money, clear down here. Market hasn't got to that price yet. Bigger risk because there's less chance the market might go down there, so they pay you a higher percentage. It's a less dollar amount, but it's a higher percentage. Smaller investment, $239, get you 23% return on the money. The gain, $56. Okay, so that's what that one's done. Now those are separated. I told you I was going to show you how to connect those together and put them all on the same ticket. I'm not going to do that now because we're running out of time. So we're going to come over and look at one more. I'll do that tomorrow. I'll show you how to do that. Positions, what other positions did we have? So we looked at Meta, we looked at Apple, we looked at Amazon. That's the other Amazon. We have an Alphabet, Google. Okay, so on the Google one, we haven't looked at Google yet, right? So Google, all we did is we bought an at-the-money call. We invested $680. The market's moving in our favor. It's doing what we anticipated. We're up 13%, 13.6%. We have a $92 gain. So overall, we're up about, on all of our positions, if we come in here and look at all of them combined, we're up. Valero Energy doesn't count because that's not one of our options. That's just one of those leftover positions. Let's just close that out. Just get rid of it because it's not an option. It's not part of our lesson. So we've invested $1,000, or we've invested $6,523 overall on all of these markets, and we're up $1,000. Okay, so we're up $1,000 in, when did we do these? 2 days ago. So $1,000 in 2 days, or 1.1% return on our money, total gain on our $6,523. Okay, so let's come over here. 1,000, that would be a 10% gain. Is that right? I'm gonna have to look at that. So we're gonna come over here, and I wanted to put on one more. I wanted to sell some more options for you. So let's kill this market because that's not part of our lesson. And where can we sell another one? We can sell one on Google. So we're long Google. We could come in here and we could, if we think the market's going to continue to rise, we could sell a call down and sell a put. So let's come in here and we're going to sell. Actually, we're going to have to sell a call, sell a put, sell a put. Let's sell a put. Oh, we want more time than that. Let's just sell a, let's look at a 64-day. We're going to sell a put down here. And we're going to collect. They're not going to give us a lot because everybody thinks the market's going up. So $145 if we sold this one. We could sell one right at the money, right up here close. That'd be $191, $145 to sell that put. Let's just do $146 just to give us an example of selling a put. So we're going to go ahead and sell that put. We'll just mark it into it. We go okay. And did they give it to us? They did. There's our put. We sold it, and we just collected $145. All right. Now again, if we just went and liquidated it right now, we'd have to give that $145 back. So we need time to decay for us, or we need the market to move significantly in our favor. If we sell a put, remember, we want the market to go up. If we buy a put, we want the market to go down. So we bought a call, so we want the market to go up. We sold a put, so we want the market to go up. All right. So we could come in here. Let's do one more just for fun. Let's come in here and sell a call. Let's come in here and sell a call. We're going to sell a call up here. Let's sell one for, there's a $100 one. Let's just sell that one just for fun. We're going to collect some money, right? So we're going to come in here. We're going to market that in, and we're going to place our order, see if they give it to us, and they did. So we just sold one up here for $100. Now you're like, but Lan, we think the market's going to go up, and if you sell a call, you want the market to go down. Well, I just don't want the market to go above that red line, right? If it goes above that red line, I lose any money. I lose my entire $110. So, and then of course I continue to lose because I got unlimited loss potential. So as far as that market goes up, I could continue to lose. But I think it's up there far enough at this point. I'm going to just, see what happens. Let you guys see what happens if we sell an option way up here when we got a long here and we got a long here. So that's another example. We just sold one for $110. Are we gonna be able to make money on it? We'll see. All right, so there we've sold some options, we bought some options, and we haven't really done any fancy strategies like an iron condor or any of that kind of stuff. We're just buying and selling right now just so you can see what happens to different options over a period of time. And we've done pretty good so far. Our options are doing all right. We made the right decision so far. Now, if the market turns and does just the opposite of everything it's been doing, in the next couple of days, this entire green could turn to all red. So that's the game you play. Do you want to take your profits right now? We're up $1,000. We could jump out right now and wait and reset and do it again. But our goal here is not to necessarily make money. Of course, that's always nice. Our goal here is to learn what these different options do when you buy them and sell them. And we're just going to watch them over time and see what they do. So I hope you're doing this in your charts and in your books and keeping up with it, placing lots of options so you can get used to it, just to get the familiarity of what we're doing here. And class is over. But before I let you go, I always have to pump one more time. If you do not have Pit News Magazine, you need to get that. It's only $1 right now. It's going to change the price. We can't keep this dollar going forever. We're going to raise the price here pretty soon. And I want you guys to have that. We're going to start putting articles in there about trading options because the magazine follows the class. That's what the magazine is. It is the supplemental information that we can write down in strategies. So we're going to start putting like these different strategies, these option strategies are going to start showing up in the Pit News Magazine. And then you'll have them in front of you, a book, a piece of paper where what we talked about in class is going to be in the magazine. So then you'll have that to always have as something you can keep and reference. So go get your Pit News Magazine. It's only $1. All right. And that's it, guys. I'm going to let you go. I hope you have a good evening. And for class, we'll see you tomorrow night in class. Today's Thursday, so tomorrow night. And we'll see you guys here on YouTube tomorrow morning, and we'll do some more of the option stuff. And we'll see if we can't make a little bit more money in our day trading. I'm going to pop over and see that real quick. We're up $600. Market's getting a little flat, a little tired, a little quiet right here. I think we did the right thing, guys, with our day trading today. All right. Take care. We'll see you guys tomorrow morning.